everybody. Our guest host today is a Squawk market master, hedge fund manager Jim Chanos of Chanos Associates. And Jim, we were talking earlier about China. People know that you have had your doubts about what's going on in China. And sometimes I think they may misunderstand them, that they think you think China's going to collapse. That's not at all what you're saying. Right. You're saying it's much more focused on a real estate bubble there. And
we've been pretty clear about that. I mean, we think that there's problems clearly in the real estate economy and then obviously in the banking system because of the real estate loans and construction companies. But no, I think people like to take what we're saying a little bit too far sometimes.
Well, let me ask you, with what you know about China and what you suspect is happening there, does it allow China to become the savior of Europe, which is what some people are pinning their hopes on?
Yeah, I mean, I sort of doubt China's going to be the savior of anybody but China. I think that, and there's a big misconception. You had a guest on earlier, I think, from 6 a.m. hour, talking about China's Forex reserves.
Yes.
And as if it's just some pot of money sitting there waiting to be distributed to needy countries or whatever. And the fact of the matter is, like any country that has FX reserves, there's liabilities against that. There are Chinese currency liabilities. When I'm an exporter and I earn my money in dollars, I go to the People's Bank of China and I turn those dollars in for RMB, for yuan, okay? So now the bank, the central bank, has dollars. It has a RMB liability against it, like any central bank. So really what we're talking about is, in effect, printing money if China is going to use those reserves at the end of the day. So there's liabilities against them. So I mean, everybody forgets that.
So it's not free money that can be
doled out. It's not free money, of course not. Yeah.
The idea, though, there was Jim Cramer had tweeted about this a little earlier, about the idea that there could be a China fund that would step up and help backstop some of the situation in Europe.
Right.
Is there room for that?
Now remember, the Chinese have funds already. So the dollar assets they have and the euro assets they have are already invested in basically sovereign debt, U.S. treasuries and euro-denominated debt. So in effect, they would have to sell something to buy something else. Again, there's not just some free pot of money sitting there waiting to be deployed. It's already deployed.
If things continue to play out this way in China, you talked a little bit about the time frame. You talked a little bit about how the process goes, but can you put that on a time frame? Well,
I mean, as it relates to the real estate economy, it's happening right now. As I said, we're seeing signs of distress. Last night's news, sales are plummeting. There actually have been riots in sales offices in some towns in October when the purchasers of condominiums in developments have realized that the new buildings have gone on sale down 20%. And people are realizing for the first time they can lose money in real estate. And I keep pointing out that the real estate market in China is only 12 years old. Since 1999 have people been able to own apartments. So this is not a market with a long history of ups and downs. It's a market that only went up for 12 years and is now about to go down. And I think that the Chinese policymakers are going to have their hands full as they juggle this. The other problem is that the Chinese banking system is not prepared for this. And we can get into this maybe a little bit later. But I've said that it's a banking system built on quicksand, and that's not much of an exaggeration. Because in the last two banking crises, 1999 and 04, the Chinese banking system was not bailed out. It was papered over. And a lot of the bad debts from those two banking crises were non-performing loans hit 40% of total loans in both cases, in no recession. The Chinese banking authorities set up asset management companies. They then put a little bit of money into those, and they had the asset management companies take on the bank's bad debts. But rather than get cash, they had the asset management companies issue bonds. So it's like swapping my $250,000 cats for your $100,000 dog. And those bonds are still on the bank's books at par. The asset management companies, we believe, are insolvent because the workouts on the loans that they took back were only 10 or 20 cents on the dollar. And I think that this is why the Chinese banking system should be sending a thank you note to Greece and Italy every week for keeping the attention off it. And EU.
What kind of scale are we talking?
Well, let's take a look at Agricultural Bank of China, which is one of our shorts, ABC. The restructuring receivables, which is what these bonds are called on the books, equal 120% of book value.
Wow.
Yeah. So, I mean, that's the problem. And this is before the raft of current loans. This is based on the old loans from 1999 and 04. And so that's what I'm saying. The Chinese banking system has got real issues. And I think that the authorities are going to have to deal with that, because you've got a raft of this local government financing that's going to go bad, as well as direct loans to developers.
Okay. Jim's with us for the rest of the program, and we'll talk more about this in some detail.
Up next, one of the architects of President Obama's health